Any of these influences could be the excuse for a counter-cyclical intermediate price movement. It could be linked to the anticipated resolution or worsening of a political or military problem, for example. Essentially, the change in anticipated conditions combined with the unwinding of the technical distortions of the previous primary intermediate trend and its associated sharp price movement are sufficient to confuse the majority. Only when business conditions are correctly expected to change from recovery to recession or vice versa is the primary trend of equities likely to reverse. Note the emphasis on the word likely. Although equity prices fluctuate around perceived future economic conditions, there have been exceptions. For example, the economy moved out of recession at the end of 2001, yet stocks continued to decline into October 2002. In that case, it would appear that the unwinding of the tech bubble was a stronger influence than was improving economic activity. That sort of decoupling, though, is far more the exception than the rule. That sort of decoupling, though, is far more the exception than the rule. In his excellent book, Profits in the Stock Market, by Lambert Gann, publishing 1935, H.M. Gartley pointed out that in the 40 years ending in 1935, two-thirds of all bull market corrections in the US stock market developed in two waves of liquidation, separated by a minor rally that retraced between one-third and two-thirds of the first decline. Observation of such corrections since 1935 also bears out the finding that most intermediate corrections consist of two rather than one or three phases of liquidation. Unfortunately, intermediate corrections within a bear market cannot be so easily categorized since some are one move affairs or consist of a rally out of a small base, while still others unfold as a very volatile sideways movement. Even though Gartley's observations were concerned with equities, this form of correction applies to all financial markets. Relationship between primary intermediate moves and subsequent reactions. In Profits in the Stock Market, Gartley published a series of diagrams using the classification of intermediate trends established by Robert Rea. Gartley's conclusion was that the smaller in magnitude the primary intermediate term movement was, the larger the retracement tended to be, and vice versa. He noted that this was just a valid He noted that this was just as valid for bull market reactions as for bear market rallies. Observations of the period since 1933 all Observations of the period since 1933 for virtually all markets appear to support this hypothesis. For example, the rally of the 1962 stock market low was only 18% compared to the mean average of 30% between 1933 and 1982. This represented part of a double bottom formation and therefore the first primary intermediate rally. This relatively small advance was followed by a somewhat larger 71% retracement. However, the ensuing rally from late 1962 until mid 1963 was 32% and was followed by a small 25% retracement of the gain. Interested readers may wish to be satisfied that what goes up does not necessarily come down and vice versa. The 1976 to 1980 gold bull market was very powerful, but the intermediate corrections were quite brief. On the other hand, the rallies between 1982 and 1990 were far less strong, but were followed by corrections of much greater magnitude proportionally. Using intermediate cycles to identify primary reversals, number of intermediate cycles. A primary movement may normally be expected to encompass 2.5 intermediate cycles. See figure 4.3. Unfortunately, not all primary movements correspond to the norm. An occasional primary movement may consist of one, two, three, or even four intermediate cycles. Furthermore, these intermediate cycles may be of very unequal length or magnitude, making their classification and identification possible only after event. Even so, intermediate cycle analysis can still be used as a basis for identifying the maturity of the primary trend in most cases. Even so, the intermediate cycle analysis can still be used as a basis for identifying the maturity of the primary trend in most cases. Whenever prices are well advanced in primary intermediate trend following the complication of two intermediate cycles, technicians should be alerted to the fact that a reversal of the primary trend itself may be about to take place. Again, if only one intermediate cycle has been completed, the chances of prices reaching lower levels in the bear market are quite high. Again, if only one intermediate cycle has been completed, the chances of prices reaching higher levels are quite high. Figure 4.3, Intermediate trends and volume. Bull market peak. Characteristics of the final intermediate cycle in a primary trend. In addition to actually counting the number of intermediate cycles, it is possible to compare the characteristics of a particular cycle with those of a particular pivotal with those of a typical pivotal or reversal cycle of a primary trend. These characteristics are discussed in the following sections. Reversal from bull to bear market. Since volume leads price, the failure of volume to increase above the levels of the previous intermediate cycle up phase is a bearish sign. Since volume leads price, the failure of a volume to increase above the levels of the previous intermediate cycle up phase is a bearish sign. Alternatively, if over a period of 3 to 4 weeks volume expands on the intermediate rally close to the previous peak in volume but fails to move prices significantly, it represents churning and should also be treated bearishly. Alternatively, if over a period of 3 to 4 weeks volume expands on the intermediate rally close to the previous peak in volume but fails to move prices significantly, it represents churning and should be treated bearishly. Coincidence of either of these characteristics with a downward crossover of a 40-week moving average, see chapter 11, or a divergence in an intermediate term momentum index, see chapter 13, would be an additional reason for caution. Coincidence of either of these characteristics with a downward crossover of a 40-week moving average or the divergence in an intermediate term momentum index would be an additional reason for caution. Since volume leads price, the failure of volume to increase above the levels of the previous intermediate cycle of phase is a bearish sign. There are essentially two broad characteristics that suggest that the downward phase of an intermediate cycle could be the first down leg of a bear market. The first is a substantial increase in volume during the price decline. The second is a cancellation or retracement of 80% or more of the up phase of that same intermediate cycle. The greater the retracement, the greater the probability that the basic trend has reversed, especially because a retracement in excess of 100% means that any series of rising throws has been broken, thereby placing the probabilities in favor of a change in the primary trend. The greater the retracement, the greater the probability that the basic trend has reversed, especially because a retracement in excess of 100% means that any series of rising throws has been broken, thereby the probabilities in favor of a change in the primary trend. Other signs would include the observation of a mega oversold or an extreme swing. See chapter 13 on momentum for a full explanation of these terms.